University of Mumbai, Mcom Sem 4, Personal Financial Planning, Question Bank Solution, Part 8. What is asset allocation and what are the strategies of asset allocation? So what is asset allocation? Asset allocation refer to an investment strategy in which individuals divide their investment portfolio between different diverse asset classes to minimize risk. Okay, as it is rightly says, don't keep all your egg in one basket. So it means that you cannot invest in one particular type of investment. You have to diversify your investment, so your risks are divided in various investments. So you have to make your portfolio in such a way that you have a various type of asset allocation. The asset class fall into three broad categories: equities, fixed income, and cash and equivalents. Okay, so what are the three broad category of asset classes? Equity, fixed incomes, and cash and equivalent. Anything outside this three category, example real estate, commodities, art, is often referred as alternative assets. Okay, so anything beside these three broad categories, which is equity, fixed asset, and cash and equivalent, anything outside these three categories are real estate, commodities, art, and is always referred as alternative asset. Now, how asset allocation works? Financial advisor usually advise that to reduce the level of volatility of portfolio, investors must diversify their investment into various asset class. Okay, so financial advisor, or when you self asset your own portfolio, it always advisable to reduce the level of volatility of portfolio. If you have all your investment in one type of investment, say if you are investing only in equities, then if the market race goes down, you will be always suffer with the huge losses. And it is only in the fixed deposit, okay, where you are getting a fixed income, then your investment will not grow. Okay, so you have to manage, or you have to balance your portfolio in such a way that you will able to take little risk, or you can take risk and you can earn, and you can meet the inflation rate. At the same time, you should also get the fixed income. Such basic reasoning is what make asset allocation popular in portfolio management, because different asset classes will always provide different return. Thus, investor will receive a shade to guard against the deterioration of their investment. Example of asset allocation. Let's say Joy is in the process of creating a financial plan for their retirement. Okay, so let's say that Joy is in the process of creating a financial plan for his retirement. Therefore, he want to invest his rupees 10,000 saving for a time horizon of 5 years. So his financial advisor may advise Joel to diversify his portfolio across the three major categories at a mix of 50, 40, 10. Okay, so here the Joy is at his retirement stage, so he want to invest rupees 10,000 saving for the time horizon of 5 years. So the financial advisor will advise Joy to diversify his portfolio across the three major categories uh, at a fix for 50%, 40%, and 10% among stock. The strategies for asset allocation: stock, bonds, and cash. His portfolio may look like below: stock, small cap growth stock 25%, large cap value stock 15%, international stock 10%. Then in the bond, he will invest in the government bond 50% and high yield bond 25%. Then in money market, he will invest 10%. So this is the way the portfolio is divided in of a Joy between stock, bonds, and cash. And in the stock also, he has in small cap he has invested 25%, large cap companies he has invested 15%, and international stock he has invested 10,000. So here also he has a variation. In the bond also, government bond which is giving a 15% return, he has invested, and high yield bond, okay, which is giving the high rate. And but here there's a risk also, okay, 25%, because here it is here the money which he is going to get is volatile. Okay, so high yield bond can give you a good return, as well as the means it returns will always depend on the market. Okay, what is the market rate? So high yield bond he will invest 25% and government bond 50%. And for the cash, that is money market. Now what is money market? It is it is like a small buying and selling of security for short term of maturity. So liquidity here is high in the money market, and the maturity period of this is also low. So your, for example, treasury bill, commercial paper, all this comes in the money market. So this is the way he has designed his portfolio. This is how the asset allocation works. Now let's see what are the strategies of asset allocation. So in asset allocation, there is no fixed rule on how an investor may invest, and each financial advisor follow a different approach. Okay, so asset allocation, there is no fixed rule that you have to keep this much money in equity, this much money in debt, and it is always depend upon the needs and wants of an individual. What are the financial goal of an individual? Accordingly, the his strategy change is also depend upon the his age, also depend upon how much monthly expenses or financial expenses is having. Okay, what are the liabilities is having, all this, how much liquid money he wants, how much he can save, everything will be depend upon everything. This type of situations will be there in which your asset strategies will be finalized. So in asset allocation, there is no fixed rule and how an investment make invest, and each financial advice follow a different approach. The following are the top two strategy used to influence investment decision, and these top two strategies are age-based asset allocation and life cycle fund asset allocation. So in age-based asset allocation, the investment decision is based on the age of the investor. Okay, so see, when you are at a young age, you can take high risk. Okay, so and you also get a longer period for your return. So where it is said that if you want to invest in equity, you should start early and you should give it some time, means you need a longer period duration so that your investment will grow. Okay, and it will grow compoundedly. So this is the way how in age-based asset allocation matters. Okay, and if you at if your age, you are in the middle age or you are at the stage of retirement, at that time you cannot take much risk. Okay, again this all depend upon the individual to individual, but age-based asset allocation uh, is means age for the investing is very important, because at when you are in the your early 20s and all, where you can take a high risk and you don't have your liabilities, like you don't have to pay for your school going children's or you have to take care of your aging parents, because you are at the early stage of your rent and you don't have much liabilities. Okay, so you can save more, you can invest more, and you can take risk also at this age. So therefore most financial advisor advise investor to make stock investment decision based on the deduction of their age from the base value of 100. Okay, so financial advisor always advise the investment to make your investment in the stock as per as your age. Suppose if your age is 50, the 100 will be base here, so 100 minus 50, you can invest 50% in stock. If your age is 20, then you can invest 80% in the stock. Okay, because there you can take high risk. So figure depend on the life expectations of the investor. The higher the life expectations, the higher the portfolio of investment committed to riskier areas such as stock market. Okay, so if you are at a your age is less, then you can take more risk, and so you will prefer to invest in the stock market. For example, using the previous example, let's assume the Joy is now at 50 years and he is looking forward at the retirement at 60. According to the age-based investment approach, his advisor may advise him to invest in stock in proportion of 50%, then the rest in their other asset. This is because when you subtract his age 50% from the 100 base value, you will get 50. Okay, so this is how the age-based asset allocation is done. Next is life cycle fund asset allocation. So in life cycle fund asset allocation or target date, investor maximize their return on investment based on the factors such as investment goal, their risk tolerance, and their age. This kind of portfolio structure is complex due to standardized issue. In fact, every investor has unique difference across these three factors. Okay, so life cycle fund allocation means what? It will depend on the major three factors. That what is the age of that person, how much risk he can take, and what is his investment goals. Okay, so if you have a high goals, that means you want a high returns from the money you have investment. So stock market is the only option where you will get high returns, but as well as there is a risk also. So what is the risk tolerance? If it happen vice versa, if your investment goes down, do you have a backup to cover up your investment? That everything has to be studied, and accordingly the portfolio has to be made. Okay, so this type of fund allocation is very complicated, as every individual has a different financial goal, different risk tolerance. Okay, and their age is also matters. Okay, for example, let's say Joy original investment make is 50-50. After a time horizon of 5 years, his risk tolerance against the stock may increase to 15%. As a result, he sell his 15% of bonds and reinvest the portion in stock, and his new mix will be 65-35. This ratio may continue to change over time based for the three factor investment goal, risk tolerance, and age. Okay, so Joy, who has according to his in the age based asset allocation, he has invested in 50% in stock as his age is 50. So the 50% investment is in stock, but after the 5 year he feels that his risk tolerance has increased, means he can take more risk. Okay, so he has sale his bond where he's getting fixed rate is, so 50% bonds he will sell, and that money he will reinvest in the stock market. So now what stock market from 50 stock market area of investment from 50% increased into 65, and in the bond where he's invested 50% of his money, it will decrease to 35%. Okay, so this ratio may continue to change over time based on the three factor. So investment goal, risk tolerance, investment goals, risk tolerance, and age. Okay, so these two are the major strategies of asset allocation. There are the other strategies too. Let us see that. Constant weight asset allocation. Constant weight allocation means buy and hold policy. Okay, so once of one of your stock has increased, okay, increase in the rate, so you're getting a good return. So what you will do, you will sell the bigger portion of it, and you will buy the another stock. Okay, so you always have the buy and hold policy. So constant weight asset allocation means what? The constant weight asset allocation strategy is based on the buy and hold policy. Okay, so these are the two a main factor of constant weight asset allocation: buy and hold. This is if the stock loses value, investor buy more of it. Okay, so the stock rate comes down, okay, then investor will buy more. For example, the price of the share is say 500 and it has come to say 350, then in that case, to cover up the losses of this 150, what the investor will do, they will buy more share in this time period where the rates are low, so that they cover up the loss, because generally after this the market rate again goes up, so this gap will be filled, so they can get the return, means this share which is now 350 will again go at the level of 500, so they can cover up their losses, and this can be also a good investment. However, if the increase is price, now suppose from 500 the share rate is 650, then they will sell off the major part of it. Okay, bigger portion they will sell, so that in this way they can take the advantage of the market being volatile, means so if the increasing rate they will sell off their stock, and at the decreasing rate they will buy more stock. Okay, so they can earn a good profit on it. So the goal is to ensure the proportion never deviates by more than 5% of the original mix. Okay, so it is like it should not be diversified. It should be always, that goal is to ensure the proportion never diversified more than 5% of the original mix. Means they should be, by doing this buy and hold or using this buy and hold policy, they will always able to recover their losses as well as they will able to make profit. Next is tactic asset allocation. Now the tactical asset allocation strategy addresses the challenges that result from strategy asset allocation relating to the long run investment policy. Therefore, tactic asset allocation aims at maximize short term investment strategy. As a result, it adds more flexibility in coping with the market dynamics so that the invest in higher return asset. Okay, so tactical asset allocation strategy addresses the challenges that result from strategy asset allocation relating to the long run investment policy. Okay, so here the long term period is taken considered for the investment. Therefore, tactical asset allocation aims at maximize short-term investment strategy. Okay, they are like whatever means they are ready to take risk at a shorter term, and they will invest more. More in the shares which are giving the higher returns. In the short run only they want to earn more. So as a result, if add more flexibility in coping with the market dynamic, so that investor invest in high returning assets. Okay, so this is how the tactical asset allocation works. So basically, in a tactic asset allocation, investor take the opportunity of economic condition, and they amplify. They have the could highlight the potential to amplify return, lower portfolio risk, and increase diversification. So this is the benefit of a tactical asset allocation. Okay, so the main strategy of this asset allocation is maximize short-term investment strategies. Then we have insured asset allocation. For investor averse to risk, the insured asset allocation is the ideal strategy to adopt. It involves setting a best asset value for which the portfolio should not drop. If it drops, the investor take the necessary action to avert the risk. Otherwise, as far as they can get a value slightly higher than the base asset value, they can comfortably buy, hold, or even sell. Okay, so insured asset allocation, there is a base asset value. If the share prices go up or they go down, uh, go in a particular set target base asset value, then the investment could sell that particular asset, or even they prefer buying at that particular base asset value. Okay, so investment are very averse to risk. Okay, the insured asset allocation is the ideal strategy to have. Means here they want to ensure their self that they will not take the risk. Okay, so they have fixed that if the asset value is suppose the share value is 100, and if it's come to 95, they will not take the risk, but they sell, because here the loss is only of 5 rupees per share. Okay, they want to do not take a risk beyond this. Okay, so they have kept that base asset value, so that there will be not very means it will not be carrying any risk factors. Okay, so this type of investment, what insured asset allocation. Okay, insured means what, there should be a surety that their money doesn't go into money doesn't go down, and they should suffer a losses. Okay, so here the base asset value matters, and which portfolio should not drop. The next type of asset allocation strategy is dynamic asset allocation. The dynamic asset allocation is most popular type of investment strategy. It enables investment to adjust their investment proportion based on the highs and lows of the market and gain and losses in the economy. Okay, so dynamic asset means what? As the name said, it is a very dynamic in type of investment strategy, where on the higher side the people will investor will sell more of a share which they have, and when the market is low they will buy more so that they can have gain and losses, whatever gains and losses are there in the economy, they take the advantage of this volatile market where the market is low and high, and they earn in this way. Okay, so this is called as a dynamic asset allocation. Okay, so apart from this two two age-based life cycle and age-based and life cycle-based strategy, we have this other strategy, that is constant weight asset allocation, then tactical asset allocation, then insured asset allocation, and dynamic asset allocation. Okay, so the constant weight asset allocation based on buy and hold, tactical asset allocation based on maximum short-term invest strategy. Then in insured asset allocation, there is a setting of a base asset value and from which the portfolio should not drop. Then we have a dynamic asset allocation, so it is based on the high and lows on the market and the gain and losses in the economy. Okay, so we can conclude that each strategy has its pros and cons. Okay, so if you are investment in the secure type of asset, then you are not be able to take more risk and you will not able to earn more. Okay, so and in the other way, if you are taking more risk and you are not having the insured strategic allocation, then you are in the position where you can lose more money. So each and every strategies has their own pros and cons and is suited to different investment need and risk profiles. Advantage of Advantage or disadvantage of different asset allocation strategy now withstanding, having an ideal asset allocation strategy in your financial plan is better than investing on the ad hoc basis. Okay, just on investing in a very impulsive way, or just investing the how market is going, or just assuming something. Instead of going for this, you can use this type of strategy, so you will be invest or create your portfolio in a better way. So investment should discuss their financial goal and different asset allocation models and strategy with their financial advice and make informed decision about what is right for their investment need. Okay, so as an individual, everyone is not smart enough to do their investment portfolio, so there are the advisor, you can discuss the different strategies with them. You can So this was the answer of our question. What is asset allocation and what are the different strategy of asset allocations? Okay. So for the next answer, please prefer subscribing and click on notification bell icon